For many Canadians, old age security, or OAS, feels like a guaranteed benefit. You've worked hard, you paid into the system, and once you hit 65, it's supposed to be there to support you. But here's what most people don't realize. The more income you have in retirement, the more of your OAS the government can take back. It's called the OAS Clawback, and for high-income retirees, it can quietly cost you thousands every year. And what makes it so frustrating? You don't even have to be rich to trigger it. In fact, many middle-income Canadians unknowingly cross the threshold simply because they draw from their RRSPs or start receiving CPP at the wrong time. The good news, with smart planning, you can reduce or even avoid the clawback entirely. Hi, if you're new here, my name is George McConechy, and I'm a portfolio manager at Novus Pro of Raymond James. I help families and individuals navigate an increasingly complex and volatile investment environment by developing customized financial plans that turn technical knowledge into practical, actionable strategies. In If Money Could Talk, I shared how taxes, especially in retirement, aren't just about what you earn. They're about how and when you draw income. And today, we're going to walk through how the OAS clawback works, why it catches so many people off guard, and what smart, proactive Canadians can do to avoid losing benefits they've earned. Part 1, how the OAS clawback works. Let's start with the basics. Old Age Security, OAS, is a monthly benefit available to Canadians aged 65 and over based on your residency, not your work history. As of 2025, the maximum OAS benefit is $727.67 per month, or $8,732 annually. But here's where the clawback kicks in. If your net income is above $93,454, you'll start to lose a part of your OAS. For every dollar over that threshold, the government claws back 15 cents of your benefit. If your income reaches about $151,000, your OAS is completely clawed back. And here's the catch. Net income includes more than you might think. That 15 cents on every dollar equals 15%. RRIF withdrawals, CPP, investment income, dividends, grossed up, capital gains, even some tax-free income can have an indirect effect. That means even if you're not spending extravagantly, your income on paper could still push you into the clawback zone. Part 2, why this matters and hurts more than you think. You might be thinking, it's just a few $100s a month. Is the clawback really that big of a deal? It's a fair question. And on the surface, the OAS clawback doesn't seem like a financial disaster. But when you step back and look at the bigger picture, over time, the impact is surprisingly costly. It's not just a loss, it's a preventable one. Let's say you lose $1,500 per year to the clawback. That might feel small, but over a 20-year retirement, that's $30,000 gone. Now, here's the key part. That's not investment risk. It's not a bad spending decision. It's money you could have kept, but didn't simply because of poor income timing. The clawback is one of the few retirement penalties that is predictable, preventable, and permanent once it happens. You can't go back and reclaim lost OAS. Once it's clawed back, it's gone for good. It hits middle income retirees the hardest. This surprises a lot of people. The clawback isn't just a problem for the wealthy. In fact, high net worth retirees often have enough flexibility to structure their income carefully, but middle income Canadians, those with between $90,000 to $130,000 in taxable income, are the ones most likely to be blindsided. They might not feel wealthy, they might still be budgeting carefully, but because of CPP, RRIF withdrawals, and investment income all stacking up, they cross the clawback line without even realizing it. And because OAS gets clawed back gradually, it's easy to miss the signs until the check arrives lighter than expected. It adds to your effective tax rate. This is the part most people overlook. The clawback acts like a 15% surtax on every dollar of income above the threshold. So if your marginal tax rate is already 30%, every extra dollar you earn above $93,454 isn't just taxed at 30%, it's effectively taxed at 45%. That's a huge jump in your tax burden. and it changes how we think about extra income. Want to sell a rental property? Planning to take a one-time RRSP withdrawal? Thinking of gifting a large dividend from your corporation? If the timing is wrong, that extra income can cost you more than you expect. And it's just not about taxes. It's about losing benefits too. It's emotionally frustrating. This part matters more than what most people admit. I've had clients say, George, I've saved my whole life and now I'm being penalized for it. And that feeling is valid. You've done the responsible thing. You've contributed to your RSPs, invested wisely, maybe even worked a few extra years to get ahead. Then you turn 65 and suddenly your OAS benefit starts shrinking, not because you're wealthy, but because no one warned you about how your income is structured. That's why I believe the clawback isn't just a financial issue, it's a planning issue. And the earlier you understand that, the more you can do to protect what's rightfully yours. In the next section, I'll walk you through 5 smart, proven strategies that I use with clients to reduce, and in many cases, eliminate the clawback entirely. It's not about earning less. It's about drawing income more strategically and making sure more of your retirement income stays in your hands. Part 3, smart planning strategies to reduce or eliminate the clawback. Now that we understand what the OAS clawback is and how much it can quietly cost you, let's get into what you can actually do about it. Because here's the good news. The clawback isn't random. It's based on your income, and income can be managed if you have the right tools in place. These are the 5 key strategies I use with clients to help reduce or completely avoid OAS clawbacks in retirement. Strategy 1, start withdrawing from RSPs earlier, before age 71. Most people wait until age 71 when the government forces them to convert their RSP into a RRIF and begin mandatory withdrawals. But that can be a problem because by then you're likely started CPP, OAS has kicked in, investment income may be higher, and now your RRIF withdrawals stack on top, pushing your income above the clawback line. Instead, consider this approach. Start withdrawing from your RSPs in early to mid-60s when your income might be temporarily lower, especially if you're retired but haven't yet taken CPP in or OAS. By drawing down your RSP earlier, you reduce the size of your RRIF and future mandatory withdrawals. You spread the tax hit over more years. You stay below the clawback threshold longer. And if money could talk, I describe this as income smoothing. And for many clients, it's one of the most effective ways to reduce lifetime tax and protect benefits. Strategy 2, delay CPP and OAS to age 70. This is one of the most overlooked strategies and one that can make a massive difference. Most Canadians take CPP, OAS at 65 because that's when they're eligible. But here's what you need to know. For every year you delay OAS, it increases by 7.2%. If you wait until age 70, you get a much larger monthly benefit for life. You reduce the number of years you're collecting it, which can reduce your lifetime clawback exposure. And critically, you buy yourself 5 more years to draw down other taxable accounts like RSPs without overlapping them with government income. This is especially powerful for clients with strong portfolios, low early retirement spending, or a history of good health and longevity. Delaying government benefits gives you time and space to reduce your future taxable income. Strategy 3, use TFSA's withdrawals to stay under the line. Here's where the TFSA becomes your secret weapon. TFSA withdrawals are completely tax-free and they don't count towards your net income for OAS calculations. So if you're close to 93,454 clawback threshold in a given year, pull income from your TFSA instead of your RRIF or non-registered accounts. This can help you meet spending needs, avoid OAS reductions, and keep your taxable income comfortably below the threshold. Many of my clients treat their TFSA like a flexible top-up account to smooth income and prevent unintentional clawback. clawbacks. Strategy 4, income splitting with a spouse. If you're married or common law and you and your spouse have uneven income levels in retirement, this one's for you. The CRA allows income splitting on certain types of retirement income, including RRIF withdrawals, defined benefit pensions, annuities purchased with RSPs or RRIF funds. That means you can shift up to 50% of your eligible income to your lower income spouse. Why does this matter? Because if one spouse is well over the OAS threshold and the other is under, income splitting can reduce the higher income spouse's taxable income, potentially keep both partners below the clawback line, and lower your overall household tax bill. This strategy often results in thousands in combined savings and more OAS preserved across the couple. Strategy 5, be strategic with capital gains and dividends. For business owners, investors, and clients with large non-registered portfolios, this is a big one. Here's why. Capital gains counts as income in the year they're realized. Eligible dividends are grossed up for tax purposes, meaning they can show up as more income than you actually received. If you sell a cottage, liquidate a stock portfolio, or take a big dividend from your holding company, you could accidentally trigger a large OAS clawback that year. What we do instead is spread out gains over multiple years when possible, use capital loss harvesting to offset gains, time dividend payouts for low income years or split them between spouses, use corporate class funds or prescribed annuities to smooth taxable distributions. This strategy is all about control, not over your investments, but over when and how the income hits your tax return. The OAS clawback isn't about earning less. It's about earning and withdrawing smarter. By using these 5 strategies together, early RSP withdrawals, delayed CPP OAS, TFSA top-ups, income splitting, and smart capital gain timing, you can dramatically reduce much of your OAS, reduce how much of your OAS gets clawed back, and keep more of your hard-earned retirement income working for you. Next, I'll share a real client story where these exact strategies made the difference between losing thousands and keeping their benefits intact. The old age security clawback is one of those things that just sneaks up on people. You've worked hard, you've saved diligently, and then just as you start to enjoy the retirement you planned for, the government quietly starts reducing your benefits. But here's what I want you to take away from this. The clawback is not a punishment. It's a signal that your income needs to be managed more strategically. Because the problem isn't how much you've saved, it's how and when you start using it. And with a little planning, you can keep more of what's yours and spend your retirement focused on life, not tax brackets. So if you want to make sure you're not losing thousands to unnecessary OAS clawbacks, I offer a free one-on-one consultation where we'll review your current income sources, including CPP, OAS, RSPs, TFSAs, RRIFs, project your future income and identify any clawback risks, build a smart, efficient withdrawal strategy that protects your benefits and reduces taxes. Click the link below to book your free consultation. Let's make sure your retirement income is structured to last and to serve you, not the taxman. If you found this video helpful, hit the like button, subscribe for more Canadian retirement insights, and leave a comment if you've experienced or avoided the OAS clawback yourself. Thanks for watching. I'm George McConechy, and I'll see you in the next video. Remember to ask about our tax-free savings account Snowball. Wow.